Good afternoon. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check us out on our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is December 14th, and it's about 2:20 in the afternoon. Oil's trading around $70. How you doing, Andy?
I'm doing good, Jim. How about you?
I'm doing fine. I just like to start out and talk about an oil conference I think you and I went to a couple of years ago, and the analyst of a major oil company said, all you have to do is get GDP and weather down, and you'll understand what oil demand is going to be. And it's not quite the case these days, is it?
No, it's not. I wish it was. Used to be. He's right. You know, those are key determinants. There's obviously other factors, but demand. Trying to figure out where their demand over the last couple of years has been, it's been really difficult. And we're looking forward to 2022 with some demand estimates basically all over the place. And our own, I keep changing them weekly, and I used to change them. I'd change them monthly or even quarterly, and now it's a weekly exercise because we just have a lot of factors, and obviously one major different factor from most of our careers, and that's the virus and the variants, and to try to figure out how they affect demand is a difficult exercise, to say the least.
Yeah, I have to say, looking at the EIA's report, it was released last week, their monthly oil report. They talk about heightened levels of uncertainty, and they've been saying that for a while now. And I'm not picking on them, but it's nice that these forecasters recognize that this is a huge standard deviation around their estimates these days. So let's talk about Omicron. The IEA report today shaved 100,000 barrels of next year's demand due to the Omicron, and I think they said mainly it shows up in jet fuel demand. And is that what you're doing with your numbers?
We're a little bit higher than that. It's not only Omicron, but also Delta, which has been way more lethal than Omicron. But we took off about 400,000 barrels a day in the first quarter of next year, which actually is, I haven't seen how the IEA distributed that 100,000 barrels a day, which is 1.2 million barrels total. And, we're at 1.2 million barrels total, but, we front loaded it into the first quarter. So, we lowered demand on that. We're always looking at what in terms of weather, we're assuming a normal weather pattern, which is, of course, hasn't really been the case, seemingly hasn't been the case,
Also a new variable, a new
variable.
Yeah.
New variable,
Yeah.
much warmer than normal, much colder than normal.
So
Not having seen where the distribution is on the IEA, we may be saying the same thing that they're saying. Unfortunately, they don't release their report to the public until like 3 months from now.
Right.
Which is
old news.
Which is it's all news, of course. if you're a subscriber, you can get that. But we unfortunately, Commodity Research Group can't quite afford the IEA
Yeah.
subscription at this point.
Yeah. Yeah. So I was thinking in one of my LinkedIn postings, I mentioned that you were changing your supply demand estimates on a daily basis. You just said weekly, so I'll have to go in and edit that post. But it's
Well,
certainly
Jim,
it seems like daily.
sometimes it has been daily. Let's get back to
Yeah.
this is so the IEA took out 100,000 barrels a day. Let's just use that.
Yeah.
There were other estimates out there of 3 million barrels a day loss, or to as much as 7 million barrels a day loss. I think that those estimates were coming out when the market had its Omicron crash the day before or the day after Thanksgiving, and you just see all these crazy numbers.
Right.
And even I was like 3 million barrels a day. That's that can't be, because we have vaccines. We've got pills to deal with
Is it,
deal with it. So
what is it? Is it three shots and two masks? Like, or is it two masks and three shots? Like, or three masks and two? I can't. I'm
I
getting
think
confused,
it's
Andy.
I think
Used to be a
it's
shot and a beer.
masks. I think a shot. I think right. I think it's whatever it is. We've got more weapons than we did last year against this
Right.
thing.
Right.
And it's hard to see where we would lose 3 million barrels a day, unless of course, Delta, and this we've seen in Europe, because Austria has, we've seen lockdowns already last month. Austria, Germany had a light lockdown, and the UK is looking like that's going. I don't know if they're going to get a full lockdown,
Right.
but they're going south. So clearly it might not be just jet fuel. There could be losses in gasoline and in diesel as well.
So where can you just quickly run through sort of demand by products up to this point? I mean, have we gotten back to 2019 levels?
No,
Uh, no.
no, we're close. The big problem still is jet fuel. If you look at some of the first quarter demand, the first quarter 22 demand numbers, actually they're pretty close. First and second quarter, we're close for estimates. Fourth quarter, using our own, we're close, not quite there. We're about 1 million barrels a day short, or maybe even a little bit less than that. And we've had, demand for gasoline has been robust globally. Diesel has been strong, owing to the economy. The global economy's coming back. Has come back. I think GDP will come in between 5% and 5.5% higher. Petrochemicals, great year it's been a great year for petrochemicals. And jet, as we thought,
Yep.
coming into 2021, the big problem was jet fuel, mostly because of the international flights, and that's still becoming a problem. Domestic travels seems to be up globally, but internationally is it's just not there, and it may not get there even throughout. Some of the airline industry is saying that even in 2022 they might not quite get to where they were in 2019 on jet fuel demand.
So, and you're not seeing any, like you're saying these numbers are good. So we're not seeing any like consumer response to these high prices at the pumps, cutting back or anything like that. The actual,
It doesn't look like it. No, it
no.
really doesn't. It really doesn't look like it. U.S. demand has been right around pre-COVID levels. Even though the pump prices have been up, have been 341 or 342 was the high. In Europe, India earlier in the year obviously had some issues with their spikes, but they seem to be coming back. Chinese demand is going to end up being pretty strong in 2021, probably not quite as strong in 2022. A lot of the anticipation is that once globally, the vaccine is more widely distributed, and that gasoline is going to be really strong. Hopefully the pandemic is winding to a close by third quarter, but gasoline expectations are for a pretty strong gasoline year. Diesel too should be growing, and petrochemicals, I think, Jim, is still going to be, maybe is going to be one of the stars next year.
Oh yeah, a lot of stuff that's been coming to my door is in bubble wrap. I assume that's a petrochemical. And then I always carry my trusty phone, which I think has petrochemicals in it. I mean, it's
All over. Yeah.
Everything. Yeah.
Everything, almost anything you touch has got a petrochemical in it. So,
Right.
and, I think that's one of the reasons why we're going to need petroleum.
Yes. And so margins are good then.
Margins right now are very good because crude has come off. Inventories are relatively low. So margins globally are strong. And I think we're going to see in December and into January and February, well, February's turnaround time, but I think December and, these next 2 months, we're going to see pretty strong crude runs. And I think we're going to see strong crude runs next year, owing to the fact that we've got some new refinery capacity coming on in Europe. And, with margins strong, and demand still good, I think refiners are going to want to run.
And there are a couple of things that have been talked about in the press. One is the skilled labor shortage. That's not showing up too much in turnarounds, you think, or is that an issue? And the other was is the natural gas price in the U.S. giving these refiners an edge over, say, in Europe?
Well, in terms of skilled labor, there are refiners probably have a little heavier slate of turnarounds coming up because there's been some deferred maintenance. I think there should be enough to deal with the turnarounds. But yeah, that's an issue, Jim. You're right. That is definitely an issue, as of course is the cost inflation for any type of material.
Right.
I think that's plaguing manufacturing, global manufacturing, of which obviously refining is a manufacturing process.
Right. And but it sounds like refiners, they're going to be should be in decent shape for at least the short term.
I think they will be. Yeah, I think next year is going to be okay. I think it's going to be pretty good for refiners, actually. Assuming that they get this maintenance done and there's no, that there's no big issues. Of course, last year in the U.S., we had two big refinery issues. One was the big freeze out in February, and two was Hurricane Ida.
Right.
So that was, that probably, that's still taking out refinery capacity. The Alliance refinery in Louisiana is going to be repurposed. That's gone as a refinery, and Norco in Louisiana is still having issues from, I believe, from the freeze out.
Very good. So it looks like the sort of inefficient refineries are going to be repurposed.
Yeah, I think, and we've seen that in shrinking U.S. refinery capacity. We've lost all those. We've lost a lot of crummy refineries, particularly in the Northeast,
Right.
which were, there were from early last century. So we're seeing, the refineries that are surviving, particularly in the Gulf Coast, are these, are a fit, have been, there's been a lot of capacity added that it's way more efficient than any of the refineries that we're losing, which is why crude runs, relative to 2 years ago are have been lower. I think as you and I were talking, they're 1 million barrels a day lower than they were a couple of years ago, although it looks like December is going to catch up.
Mhm. So how does OPEC Plus respond to this demand question? Omicron, just basically the difficulty in sort of demand estimates could be plus or minus a lot. I mean, how do you manage your supply? What they have decided to continue with their 400,000 barrels a month. It's a month by month decision. Where do you see them coming out on that?
I think that I think it's going to be stay the course, Jim.
Mm-hmm.
It seems to have worked. Prices aren't where they were last, in October, but the 60 to 70 level or 65 to 75 level, they can more than live with that. So I think that as long as prices stay, around here, a little higher, slightly lower, I think they're still going to unwind their deal. They're in the process of unwinding it, and I think that they are going to, continue unless prices get way lower. Then they'll certainly have a rethink. They also they don't know what the results of the nuclear talks are going to be. Right now their deal is through April of 2022, and as next year unfolds, they'll probably have a better idea of what their policy is going to be as we head to the second and third quarter of next year. Now, I think what's important is that we're talking about demand, growth and demand next year, but there's also going to be a growth in supply, and it may be a little more difficult for OPEC to manage their supply. In fact, it looks as though if you look at the balances, Jim, like
Mm-hmm.
it looks as though there's going to be slight builds to bigger builds, depending on which agency you look at, for at least the first half of next year and possibly for the whole year. So, those supplies are coming from, there'll be non-OPEC growth by particularly us, the U.S. Should have a big year on both crude and NGL production next year. And Russia too is going to have a big year. At least we're forecasting a big year, or everyone's forecasting a big year for Russia. And there could be room for there should be room for OPEC to increase production. The question is, as always, how much?
Yeah. Yep. I mean, there's talk that they're having trouble. OPEC Plus is having trouble meeting their increases. Do you think that's going to be an
They
issue?
are. Yeah, they definitely are, because the West African producers are not coming close to their quotas. Most of the growth is coming from the Persian Gulf producers, and they're the ones that are going to have to add the barrels if the market needs it.
And you
So yeah, they're not even they're not making their nut.
and you said the Iranian talks have started out in trouble, not in trouble, but it doesn't look good for a quick resolution with Iran. And do you think that's just posturing by Iran, or you think it's? I think you're basically, for a while you didn't expect Iranian oil on the market for a long time. Is that still you're still saying that, right? Is that what you just said?
Yeah, I don't see it in the first half of 2022 at least.
Right.
And we'll see what happens in the second half. But the talks couldn't have gone worse. because Iran handed the EU the document that basically countermanded a lot of the stuff they had already negotiated. So, it wasn't a good start. Like, as you said, Jim, it could be posturing, sure, but kind of a brutal start.
Right.
So
So
we'll see. I'm not optimistic. I wouldn't be too optimistic.
Yeah, I was going to say we'll only keep one eye on that, not both. So, from a policy standpoint, would you rather be the oil minister of Saudi Arabia or the Fed chairman?
I probably, well, in the short term, I probably want to be the minister from Saudi Arabia.
Okay.
Actually, even longer term, they're going to be they're going to be around, as an oil producer for forever.
Right.
So the Fed chairman,
yeah,
who knows?
Who knows? I just looked up on the Fed's data website, Fred, and I looked up the Taylor rule. That's that mathematical formula to see where the Fed funds rate should be based on the GDP and inflation, the CPI, and it says we should be at 2.5%. And I think their effective Fed funds rate is around 0.1 right now. So that's going to be an interesting. There's problems with the Taylor rule, I know, but it's just sort of it's a formulaic idea of where the Fed funds rate should be based on the economic conditions, and so we'll see what happens. Yeah, getting back to your production.
Yeah, I actually I wanted to ask you some questions.
Okay.
I wanted to talk a little bit about options.
Well, there was a
lot of shake, rattle, and rolling last month.
There was volatility on that day after Thanksgiving's got up to 67.5. That's in WTI. I tracked the second nearby at the money option, and that would be the third highest spike that we've seen. And obviously it's not as big as last year's when we went to negative prices and smoke came out of the option models and the option traders, but it's a pretty big spike. It was not on great volume. I didn't see, at least WTI volume was nothing out of the ordinary, but you did get that vol spike, and it came down to 42.4 yesterday. I think the whole story of this year has been the call and call spread buying at higher and higher strike prices. Except for early in the year, we saw those DEES 22 calls go, the 90s, the 98s, the 100s. The 100 call still is by far the number one open interest contract with 68,000 open. The 98, this is WTI, and is second with 32,000. And so as the price rallied through the year, we saw some of the again call spread buying. To give you an example, in WTI, the biggest put out there is the June 22 put with 21,000. So Brent puts have a little more. The June 60 put is number one with 34,900, but their calls are not very high. So and having said that, the kind of the crazy trade in Brent were the $5,250 calls for DEES 22 and the 5,350 calls for DEES 22 traded. Now that's probably one person, and I was thinking, if that thing goes in the money, a better trade probably would have been buying canned goods. You at least once that option goes off the board, you still have the canned goods. Money's probably you make if that call spread goes in the money, that cash is probably not going to do you any good. What I'm saying, we're in some dystopia type of environment if that should happen, I would think. But anyway, that was like the craziest one. But also one that slipped my I didn't see this to the very end. but there were 36,000 open interest contracts open on the December 100 euro call for carbon emissions. So that contract has come of age after, I don't know, 10, 15 years now. That's a big number. 15,000 lots traded on December 8. And that was a couple days before expiry. And the market trade, I think it traded up to 90. So, it reduced open interest by 10,000. But those are big numbers. Like that carbon emissions contract has been in a bull market. My neighbor works for a company that has an ETF in that. It's a Crane Shares, and that thing is up over 100%. So, it's going to be interesting to see. Every trading company has a desk now trading these carbon credits, and I think you kind of have to grow a forest to sell into this thing. So I'm not saying it can only go up. It's already come off its high, but it's going to be interesting to watch, because you get ETFs and these traders you think are going to be playing it from the long side naturally, and then you have long only strategies basically, and then so who's going to sell it? Is kind of hard to I guess we get a recession. That would bring it down. Omicron certainly would help bring that thing down. But like I said, in order to be a seller, you have to get a more efficient process in your manufacturing, or you have to grow a forest. And that's hard to do.
Well, yeah. I mean, if you're generating carbon credits, right, you could sell it as a hedge, right? I mean,
If you're generating, that's right. And how?
So
Yes.
there is a natural seller to the market.
Yeah, but the way to generate them is you have to be more efficient, right?
Oh,
Yeah.
yeah.
So yeah. I'm being a little exaggerated. I'm exaggerating a little bit, but the thing looks like it's gone straight up. Even before Glasgow was going up, and then afterwards it went even higher. So, but we'll keep an eye on that. I understand that some analyses are done in California suggesting that $30 as a carbon credit would start moving major groups out of the state, and that's where it is now. So we'll see if that happens. Anyway, there's on that dive down after Thanksgiving, people talked about something in the options world called gamma rush. And what happens in the oil market is that you get a lot of producers buying puts. Think about Mexico buying maybe 200 million barrels of puts over the year. But many of the producers in the U.S. and around the world like buying put strategies because it's an insurance contract against lower prices. And if prices rally, they're not stuck. They get to participate, unlike selling futures. And also, if they're hedging, say, a year out, they don't have to pay margin on a contract that's a year out, and that they're not going to get the cash sale for a year, right? So they don't have that mismatch in cash flow as well. So in oil, that put buying dwarfs put selling by any people, that speculators that want to sell. So you have these market makers, banks, over-the-counter dealers, all kinds of people like that, that will sell the puts, and they don't get to buy puts around those sales because the paper flow doesn't help them out. So they're stuck with these short put positions that are out of the money. And so the way they hedge those is by doing something we call delta hedging. So if you look at an out of the money put, the delta will tell you how does that premium move to a move in the futures price. So an out of the money put might look like a third of a future. So if the futures moves down by $1, it moves by 33 cents, say. But as the price keep moving down, those deltas change. So think about a put that goes deep in the money. It starts moving around almost 1-for-1 with the futures, because once you reach expiration, it's likely that deep in the money put will become a futures contract. It'll get exercised. So you're going from, say, 0.3, the market goes down, it goes to 0.5 to 0.7. And so in order to neutralize that, when the position's put on, would say, let's say a 0.33 delta, the market maker sells the put and sells 33 futures for every 100 contracts they do. And so as it goes down, the price goes down, then they have to sell more futures as that price goes towards that strike. And we had I can't remember, was it 13% move? How many? We blew through a lot of strikes on that Thursday. So those market makers had to sell futures on the way down. And as they're selling on a day like Thanksgiving, the liquidity is tends to be less than normal. And so they put an offer out there and the bids run away, and they have to, the next offer they have has to be higher in size because they missed selling, their deltas at a higher number. So that process is what we call a gamma rush. It's these option market makers that get caught short, in this case puts, and they're using the futures to hedge. And again, what you'd like to do is buy puts around the strike you sold, because then that'll neutralize your gammas as your short option deltas are moving against you. Those long options that you have move in your favor, and it happens automatically. You still may have to hedge, but it won't be as panicky as when you're stuck short options. Does that make sense? Or
yeah, that was a great explanation. So here's a follow-up question. A lot of the press was saying that the reason the market came off was because of this gamma rush. Do you think that has any validity?
Well, I think it may be a little bit, but let me just point out that when the carbon credit market rallied towards 90, the papers were saying that the market was trying to go to the strike of $100 where all the open interest was. So we have these countervailing theories, Andy. One is the option magnet theory, that the market will move towards the strike, and the other one is the gamma rush theory, where the market is blowing away through the strikes. So it's a two sub theories of the tail wagging the dog theory, that options flow will have an impact on prices, but it's usually pretty small. And in this case, you need maybe it's the kindling. You need somebody to strike a match, and I think the match was the Omicron, and maybe also the fact that it was the day after Thanksgiving and there was very little liquidity. So, and then and so yes, I think it's a valid reason. But I would put it down, with with a dollar change.
Right.
Had to throw that in there.
Another thing the press always likes to blame a market move when they have nothing else to talk about, I'm afraid.
Well, we used to hear people way back in the day on the floor, whenever no one could explain something, it was Fibro, right?
That's right.
Fibro's buying, Fibro's selling, and then after that, it was funds. Funds are buying, funds are selling. And then it always was the locals. Locals are, taking it higher, taking it lower. And you get these folks individually and they go, oh, it wasn't us. I don't know what you're talking about. So, yeah. And even Andy, I don't know if you were there, but we had a conference in our office where we had a Wall Street market maker, options guy. We had one of our oil customers that was trading monster amounts of options, and we had a floor trader. It was Jim Zamora on a panel, and somebody in the audience said I think it was to Jim, said, why are you guys always moving the futures around on expiration day? And he said, we're not doing that. It's these guys. And he pointed to the Wall Street guy, and the Wall Street guy said, it's not us. We thought it was these guys. So there's and so, yeah, it happens, but it doesn't happen often. And there's usually something else bigger going on in the marketplace. Which leads me to ask you a question, Andy. we have these dueling. If you do look at the IEA and the EIA, they have these charts showing supply demand, going forward for about a year, and they have the history, and they show you the draws and the builds. And the EIA looks like a balanced market. First quarter, second quarter, third quarter, fourth quarter. The IEA looks like the much bigger builds, and especially in the fourth quarter, it's going crazy. So, one looks at a balanced market that would indicate to me low volatility market, and the other one, big builds, that would indicate to me a high volatility market. And what are you thinking? What's your thinking on those?
Well, the difference there is that the IEA just said, all right, let's say OPEC does add monthly to the end of the year, or until September, that they add and make their 300,000 barrels a day that OPEC adds, and the 100,000 barrels a day that goes to non-OPEC, mostly Russia. So think of it this way. So every month, the IEA is adding on another 300,000 barrels a day of supply. So by September, that's another 2.7 million barrels a day of added supply. The EIA doesn't do that. So that therein lies the difference, why the IEA is showing these big builds. The EIA, alternatively, just has OPEC production as flat through the rest of the year, which is also not right. I mean, they just threw a number out and saying OPEC's production is going to be 28.4 million barrels a day for second, third, and fourth quarter, because they basically punted. They don't know either.
Right.
What the
Right.
OPEC strategy is. So
Yeah.
the answer, high volatility, low volatility, it's probably somewhere in between.
Right.
You
Yeah.
know, of course, we don't even know. The one thing that is going to be different about next year, and we don't even know, or the one or two major events of next year, we have no clue what that's going to be. Because I think, Jim, as you and I have often said over our long and somewhat distinguished or indistinguished or undistinguished careers,
Extinguished.
yeah, extinguished, right? Is something, something happens that you can never have foreseen in the market, whether it's geopolitical in a country that you had no clue would be an issue, or something happens on the weather front, something, there's bound to be something that no one is forecasting.
Yeah. I mean,
It happens almost every year. I mean, you can talk about the forest fires in Canada, for instance, a few years ago, or
right.
crude getting stranded in the Midwest, or a whole host of things.
Not to mention the Russians massing troops on the Ukraine border, and
Right. But that
yeah.
we can see. I mean,
Well,
that, that one we could see.
yeah.
Like you couldn't really see that Libya would stop exports years ago, with
So
the Arab Spring.
I'll give you one quick story. When I first got into this business of options world, I had two speculators, and they were bullish the stock market. One of them bought futures, the other one bought calls. The market immediately went down, and it stopped out the guy who bought futures. The guy with calls hung on, and the market turned around, it went up. And I tried to get the guy back into the futures, but the price was above the place where he sold it, and he couldn't, psychologically do that. And for the next month, this was like in I believe it was August of 1984. The market went straight up. Those calls went deep in the money, and the guy was on vacation. He comes back, and we start selling futures into the rally. The market dipped. We bought them back. It rallied. We sold them. And this guy, he was a doctor. He said that he was like, he's never made so much money in his life. It wasn't a lot, but I mean, this was back a long time ago. And from then on, I said, wow, these options, have a lot of, you for a small speculator, can give you a lot of staying power. And that stuck with me ever since. Even with like big oil companies, I think they've probably, if they haven't had any asset against their short option positions, I think they've had a hard time. Maybe made some money over time, but for me, my bias is on the buy side of options, because I know exactly what my risk is going to be, and I can sleep at night with those positions on, and it's even more so now. I mean, just look at the last few years. So,
Oh, yeah. I mean,
you
you've
know,
said that consistently, over the last, decades, over the many decades that we've known each other.
yes,
You've always said you prefer to be a buyer than a seller
yeah.
of options.
So if I'm going down, it's going to be by 1,000 cuts, not by the, you
Not
know, not through
that one position.
not through the spike
The
through the
one
heart.
you, the, the one you'll be gamma rushing as the market
Right,
as the
right,
market collapses.
right, right.
Uh,
So listen, you're trying to sneak out of here without talking
I
about
am. I'm trying to.
prices.
I was about to end it.
Yes. Well, we want to talk about. I was asking you before this podcast, and you shut me down. I was asking you what's, if you think about the last barrel of oil that's traded, what's its price going to be? Is it going to be really high or really low? And you just, kind of slap me aside. So I'm not going to talk about that. But let's. And then I was going to say, well, what's the path to that price? I'm thinking about the energy transition as we move more and more into green energy. We see that it's got some major problems with, we see it in Europe, we see it around the world with natural gas, where we're seeing fuel switching because the winds stop blowing. We have these weather events, and the green energy is not ready to take over yet. So we're just talking about 3 months from here, though. Andy, what can you give me an idea of what you think's going to happen when we'll put a very large standard deviation on this estimate?
Just for the first in the first quarter.
Yeah, just like first quarter. Yeah, we still have December left, but yeah,
Yeah, we have 3 weeks of December. Yeah, we have a
yeah.
couple
So
3 weeks of December left, and then we've got, and then we've got the first quarter. I have, just looking at my balances. I
yep,
mean, I have a build of 1 million barrels a day in the first quarter, which, that is going to put the market on the defensive, I think. But because inventories are still, they're still low. It's hard for me to see the market coming off, all that much. I mean, WTI got down to 62. Can it get back down to 60 or the high 50s? Yeah, for a warm winter. Yeah, I guess it could if we have no winter at all. And obviously there's a lot of uncertainty on the variables. But I think the market is going to try. I hate saying this, but I think this is what's going to happen. I think we're going to try to get into some kind of range in the first quarter. Maybe something like 65, 75, something like that. We wrote it on monthly. We thought that 70 would be the equilibrium price for WTI when things settle down. So I'd still go with that. And it does look, Jim, more and more as if, at least for 2022, the talk of really acute shortages and energy crises, and just looking at the numbers, right, and our best case, that doesn't look like it's going to be the case for 2022. 23 and 24, that's a different story. So that's kind of what I'm looking at right now.
so at $70, you're basically saying, let's take $20 away, 90 or 50. Which one do you think has a better shot of touching? not saying it hangs down there, but or which one do we hit first?
That's a tough question.
Yeah.
I
Okay.
don't like either of those prices, but
Oh, so
you know,
okay.
I guess 50, if there's absolutely no winter, we have a shot at 50, I guess, first.
Okay. And then you don't think we're going to get up into that 9,500 area?
No, unless again, if it's Arctic blasts for a long time, then you're looking at, then demand is going to pick up. And there's fuel switching, as you mentioned.
Right.
So, that's just that's weather, that's weather stuff.
And then there's this underlying assumption you're making about Omicron as well. That's kind
Yeah,
of
but it's not going to be,
deadly.
it's not going to be deadly.
All right. Anything else, Andy?
No, I think we covered a lot.
Okay. I'm going to call it a day. And I'm still putting stuff up on LinkedIn. I put the podcast up on LinkedIn. As I mentioned earlier, it shows up in EKT Interactive. It shows up on our website as well. And we'll see you next month, Andy.
We'll see you next month. If you want to reach me, I'm at Lebow, ALEBOW at commodityresearchgroup.com. Andrew Lebow. I'm also on LinkedIn. And if you have any questions or comments or criticisms, we'll take the first two, but not the third.
Terrific.